All right, let's dive right in. Today, we're unpacking SBI Life Insurance, India's biggest private life insurer. The big question, of course, is this a smart place for your money? Let's figure that out together.
First up, let's just throw a massive number at you to set the scene. 5.12 trillion rupees. Yeah, you heard that right. That's the amount of assets SBI Life is managing. It's an absolutely huge number, and it tells you right away just how dominant they are in this space.
Okay, so I'm going to flip the script a little bit today. We're actually going to start with the verdict right up front. The call here is accumulate, with a fair value that we see landing somewhere around 2,100 rupees. Now, the rest of this analysis is all about the why. How in the world did we get to that number? Let's dig in.
First things first, we've got to talk about the most important thing for any long-term investment, its competitive advantage. You know, what Warren Buffett famously calls a moat. It's basically the special sauce that protects a company from all its rivals. What is SBI Life's edge?
So how do they actually sell their policies? Well, take a look at this. A whopping 62% comes from something called bancassurance. It sounds fancy, but all it really means is they sell their insurance products right inside bank branches. And this, right here, is the key to their incredible power.
And just how big is this channel? Well, check this out. Over 41,000 partner bank branches. We're talking mostly about their parent company, the State Bank of India. I mean, think about that. It's a physical, on-the-ground network that is virtually impossible for anyone else to build. It is, hands down, the biggest distribution machine of its kind in India.
Okay, so a massive moat is great, but what makes it really valuable? Well, it's sitting in a market that's just getting started. Right now, insurance penetration in India is only about 4%. Compare that to the global average of 7%. That gap represents a huge runway for growth. And SBI Life is in the perfect spot to capture a giant slice of that pie as it grows.
All right, so the story sounds great, right? A powerful moat, a growing market, but talk is cheap. Do the numbers actually back it up? Let's pop the hood and take a look at the company's financial health.
At a quick glance, you can see a nice, steady story of growth. But your eyes should go straight to that last column. Look at the profit after tax, or PAT. It didn't just grow, it shot up. We're talking an acceleration to a massive 27.4% growth in the last fiscal year. That's pretty impressive.
And this chart really drives that point home. You see the solid growth in the years before, and then bam, fiscal year 2025 shows this huge jump in profitability. This is exactly the kind of momentum shift that makes investors sit up and take notice.
And here's something you just have to love: zero debt. In a world full of economic uncertainty, a company with no debt is just solid. It's like a financial fortress, built to withstand pretty much anything.
But you know, no company is perfect, and a fair analysis has to look at both sides. So let's talk about customer loyalty, or what the insurance world calls persistency. The good news? Short-term loyalty is looking great. More customers are sticking around after the first year. The not-so-good news, the long-term picture, after 5 years, is actually trending downwards. And that's definitely a metric we need to keep a close eye on.
So let's put it all together into a little watch list. These are the things to be aware of. We've got that declining long-term persistency. Their solvency ratio, which is basically their financial cushion, has dipped a little. And then there are potential hits to their profit margins from tax changes and rising costs. Now, I wouldn't call any of these deal breakers, but they are absolutely things you need to monitor if you're an investor.
Which brings us to, well, the million-dollar question, right? We've established it's a fantastic company, but is the stock just too darn expensive? Let's tackle that head-on.
And yeah, when you first see it, that price tag looks, well, pretty hefty. A price-to-earnings ratio of 77 times. That's high no matter how you slice it. And you're probably thinking, isn't all the good news already priced in? But hold on. When it comes to insurance companies, the PE ratio doesn't really tell you the full story.
See, for insurers, there's a much better metric we need to use. It's called the price-to-embedded value, or PSEV. Think of it this way. It compares the current stock price to all the future profits the company is already on track to make from the policies it sold. It's a way better way to figure out what an insurance company is actually worth.
And here's where things get really interesting. When we look at that PEV ratio, the whole picture just flips. Suddenly, SBI Life at 2.4 times is actually the cheapest among all its major competitors. And get this, it also has the highest VNB margin, which means it's the most profitable when it signs up new customers. So let that sink in. It's cheaper on the right metric, and it's more profitable. That's a powerful combination.
All right, so we've covered the moat, we've gone through the financials, and we've put the valuation in the context. Now, let's put it all together. What's the bull case versus the bear case here?
So if you're a bull, you're buying into that incredible SBI distribution moat. You love the best-in-class profitability, the massive growth potential of the Indian market, and that rock-solid zero-debt balance sheet. Now, if you're a bear, you're worried about that high PE ratio. You're keeping a close watch on that dropping long-term customer loyalty. You're seeing big foreign funds selling, and maybe you're a bit wary of their reliance on market-linked insurance products. So it all boils down to this, doesn't it? Is this amazing, wide moat company, this potential long-term compounder, worth the price of admission? Is the quality on offer worth the premium the market is asking for? Ultimately, that's the call every investor has to make for themselves.
Before we wrap up, a quick but important disclaimer. The analysis shared in this video is for educational and informational purposes only. I am not a SEBI-registered research analyst or investment advisor.
Investing in the stock market involves significant risks. The data and charts shown are based on public information and my personal research notes. Please do not treat this as a buy or sell recommendation. Always conduct your own due diligence or consult with a SEBI-registered professional before making any financial decisions.
If you found this deep dive helpful and want to stay updated with more stress-free investing analysis, please hit the subscribe button and press the bell icon so you never miss an update.
I want to hear from you. Which Indian-listed company should I analyze next? Drop the stock name in the comments below, and it might be the subject of my next video.
Thank you for watching, and keep your investing stress-free.